beautiful Sunday, November Sunday morning. Today is, of course, November the 21st, 2021. And hopefully we'll have another great little seminar today. And it's cold outside, and it's not something that I need to point out to anybody. But I thought it was funny. A friend of mine just recently got back from Australia. And he sent me a message this morning. Oh, you can barely hear me. Can barely hear me. Using the right mic. Oh, sorry. I hope that wasn't too loud. Can you hear me now? Am I still really quiet? Okay, hang on a second, dog. Everything is. All right, my apologies. I was saying, obviously it's cold. It's towards the end of November now, and I just got a message from a friend of mine this morning, who had kind of recently come back from Australia, and he was saying he'd forgotten just how cold it gets here, which of course is kind of funny because it's only November, and of course he grew up here, so it's funny how quickly you can forget what things are like. Anyways, I thought that was very mildly related to real estate investing, or kind of to life in general. Just we all have what we call domain specific knowledge, right? So that's the knowledge that you have that's particular to a certain domain. So, for example, we'll pick on Natalie in the audience. She's a teacher. She has domain specific knowledge. She knows things about teaching in classrooms that myself or Elias, for example, would not know, right? Because we are not in that domain, right? Elias is, of course, a francophone, so he can speak French. He has domain specific knowledge about communicating with people in French, right? And that may mean he knows things about what is happening in Quebec, for example, by speaking to French people there. That perhaps myself, I actually do also speak to French people in Quebec for my job, but we don't speak in French. But maybe Natalie, she has no interaction, for example, with anyone in Quebec, so she maybe is not as aware of what is going on with the people and the culture and whatever else there as maybe Elise would be. This is domain specific knowledge. Now, of course, real estate investing in this seminar, the purpose of this seminar is domain specific knowledge. That is, I have some domain specific knowledge about investing in real estate, and the goal and the hope is to share it with you so that you can use that knowledge to empower yourself to be a better investor and hopefully just a better individual who is able to create financial independence and individual wealth for themselves, maybe even some familial or generational wealth if you play the game real well. And so I thought that was kind of funny because I think that real estate has its own domain specific knowledge, of course. And everybody learns a little, not everybody, sorry, most people learn a little bit of it at some point in their lives when they decide to become a homeowner or a landowner, property owner of some sort, right? Now, of course, there are some people who they will never own any land or property. They'll be tenants or whatever you want to call them their entire lives. That's the thing that happens. But for your average person, they'll probably at some point at least attempt to buy something, so they'll learn a little bit about real estate. And I just want to point that out because obviously, in order to excel at any given thing, you have to have a lot of domain specific knowledge, right? Like a soccer player. Yeah, we'll use a soccer player, right? So if I were to take somebody, I don't know who's a good soccer player. If I were to take like an Mbappe or Lukaku or something, right? Like these are young men. Well, Mbappe's a young man, Lukaku not so much. These are men who, of course, have got just an absolute wealth and depth of knowledge about the beautiful game, right? And if you were to sit down with them, right, and if they were inclined to talk to you about soccer, which they probably wouldn't be because who are you? But but if they were, you would find that their knowledge of the game is encyclopedic, right? Not only do they know all the plays and styles and tricks but they could tell you, perhaps when they were last used effectively, who used them, why you don't use them anymore, etc., etc., etc. Right? So, domain specific knowledge is what allows you to excel in your field, right? Whatever that field is, right? And so I just want us to all keep that in mind because you can gain and lose domain specific knowledge, as my friend did, right? He had domain specific knowledge of being a Canadian. Then he moved to Australia for a few years. And turns out you don't need a lot of that knowledge when you're in Australia. You need different knowledge. So your brain does what brains do. It kind of shunts the stuff you're not using to the back or forgets it completely and replaces it with the things that you need to know and brings those to the forefront, right? And so now that he's come back to Canada, he has to readjust to the cold, which I thought was kind of funny. Of course, we all have to because of summer, but I guess it's a little worse for him since he's had a 4 year summer instead of just the 6 month one. And how does that relate to our investing? Well, the more you immerse yourself in the investing, the more domain specific knowledge that you'll get. There's actually not that much you have to accumulate. But as you get that domain specific knowledge and you become confident on it, you're going to act on it. And what happens, generally speaking, is that because you have this domain specific knowledge that everybody else lacks or that most other people lack, right? You will come to behave differently from those people, right? So in the same way that my friend is now having to acclimatize to the cold, right? Uh, because he had become adapted to the warmer environs of Australia, right? You may become adapted to looking at the world in terms of assets and liabilities, right? Which will then mean that you do not see the world like your average person who perhaps only looks at prices, right? And there's nothing wrong with prices or looking at them. They're a great tool, especially if the market is working correctly. Um, but you might look a little bit deeper. You may overstand those people, as it were, when you look at something like an asset, whether that's real estate or something else. And that'll create a bit of a distinction between you and them. And it's something to keep in mind, anyways. This week, I want to talk about analyzing real estate. I just want to kind of dive in and analyze some properties and look at some things. I wanted to take a look around at kind of um, how do we put it? Some of the prevailing kind of market, prevailing market trends that we're seeing out there. I guess you could say, and maybe look at some properties and see if any of them make any sense, right? So, sorry, got too much stuff here on my computer. So, uh, I took a look today. I actually want to show you a property that I thought was very interesting. Sorry, actually, I shouldn't do that. I should do this first. It's a property that's for sale actually in Toronto, so it's a little different from what we usually look at. But I wanted to share it with you because I think, well, I wanted to show you what kind of opportunities still exist in the GTA. And while I think this is a very expensive property, I don't think it's crazily priced, right? So let's dive in here. I gotta cast this to you guys. So hold on a second here. There we go. So this right here now has my screen taken over. Yes. So I want to show you this big, beautiful brown oblong building. So this is located in Etobicoke/Toronto, the Junction area. If you're familiar with it. And this is 97 Connolly Street. So it is listed right now. Actually, I'm lying to you already. This property in front of us, this picture on the screen is actually 97/99 Connolly Street. The two properties abut each other. And so they're two separate properties, okay? But they are both for sale. So right now, the seller is selling. Do I have my highlighted tool here? So right now the seller is selling 97. That is the worst effect. Not do what I want at all. They are selling 97. There we go. They're selling 97 Connolly Street. And then they also have for sale over here 99 Connolly Street. So those are two separate properties for sale. They are selling them either separately or together. They don't care. They're indifferent. So the cost of these properties is $1.25 million for 99 Connolly. Uh, I hope I'm getting my numbers right. I might have them backwards, but for 99 Connolly, it is 1.25 mil. For 97 Connolly, it is 1.75 million. In total, 97 Connolly is a triplex, and 99 Connolly is a sixplex. So in total, these are 9 units of property. Okay, and in total, of course, 1.25 million plus 1.75 million is $3 million. So they are selling a 9 unit multifamily building in the heart of Toronto. Well, not the heart, but the immediate outskirts of Toronto for $3 million, which means that we have an average per unit cost of what, $310,000, somewhere in there. Let me make sure I'm doing my math right. What's that? 3 mil over 9 is, oh, sorry, $333,000 per unit. I'm kind of sad with myself. I didn't get that math right away. But anyways, $333,000 per unit is the valuation here. So you can see about double, a little more than double the double the per unit cost of what a unit in Sudbury would cost you, right? And so here they've given us all the rental information. So I just want to run through this real quick and show you how this property would perform if you bought it. It's not super duper cheap. So obviously, first things first. Um, Actually, no, I shouldn't say obviously. Okay, a sixplex is a awkward property for real estate investors, for bankers, for mortgage brokers, probably even for insurance agents. It's awkward because that is considered commercial by most lenders. Um, and so you're gonna run into that like trouble spot of, is this a commercial property or is this a residential property in terms of your financing? And because they're being sold together, if you were to try to buy them together, I'm not sure if lenders would treat this as if you were acquiring a nineplex or as if you were acquiring two separate properties that were both residential. I believe that the seller may have split these up because they were trying to get around that so that they could get higher um, valuation on their property. Because if you look at the property, if you can see the picture, for those of you who can see the picture, it's one building. I don't see a distinction. It doesn't seem to. It seems to be contiguous. So my guess would be is that this was one building. It was a nineplex, and then they somehow legally severed it into two separate properties to try and sell it for residential values instead of commercial values. Because as a commercial property, whatever, this thing's probably worth like 1.8, $1.9 million, because that's probably about the annual revenue it produces, right? Sorry, it probably produces a tenth of that in annual revenue. But as a residential, then obviously it's just at the market value of the houses around it, and we all know that Toronto's been crazy for some time now, right? So I believe that's what is going on here. I obviously don't know. You'd have to talk to the realtor to get better insight. But yeah, we have these two separate units divvied up the middle there. So if this property costs $3 million and that's what they're asking, the first thing that we can note is that their price is probably too high. This property has been on the market for 68 days, according to Realtor.ca, which means it's been listed for going on 2.5 months, right? And that's pretty bad for a place in Toronto. That means you're overpriced, right? If something is priced right in Toronto, it will sell within a week. That's about right. So the fact that this is taking so long to sell means that it's not priced right. The price is either too high, or as I pointed out earlier, maybe there's an issue with financing because people are trying to buy them as residentials and the banks aren't going for it, or vice versa. Right, so I'd immediately guess you probably get this down to, I don't know, maybe like 2.7 mil. Let's say like a 300,000 per unit valuation. Um, that's what I'm thinking. I mean, the seller might not be desperate to sell. The thing probably makes money for the current owner, so they may be in no rush to get rid of it. Um, it probably wouldn't make money for you though, and we'll show you that in a second. So to purchase this property, I am assuming you'd have to do it as a commercial property. If you didn't, that'd be amazing, but I think you probably would have to. So you'd have a down payment of $750,000, which makes this, not the easiest property to afford, certainly. But you could borrow that money. You could syndicate the deal. This is a small property to syndicate, so you probably wouldn't do like a formal syndication where you actually went through the whole legal process. But you might, do a larger than normal joint venture where you maybe would have three or four parties instead of one or two. Yeah, or maybe even five or six, right? Just so you could get together that money. That's your down payment, 25%, $750,000. I analyze this at a 2.5% interest rate. You can get lower rates right now, but try to kind of play it safe, be conservative. I'm not sure what exactly you qualify for. Usually the rates are slightly higher on commercial stuff, right? Um, this works out to a monthly mortgage payment of $9,500. Okay, so that's a lot of scratch. Down here, we've got our missed closing costs, and they're all pretty much the same. I did bump up some of my legal costs and some of my closing costs just a little bit because A, you're in the city of Toronto, so the services are just a little more expensive, and B, you may run into some things with a nineplex. But basically, you need about $800,000 in change to close on a property like this, right? So let's go and let's just take a look at how this thing actually performs. So it produces about $156,000 per year in income. Those are the realtors' numbers. They may be BS, as you know, but approximately. And that breakdown is actually $58,786. You see that on the triplex portion, right? Uh, there you go. Here's my numbers clarified right there. So 99 is the triplex and 97 is the sixplex. Sorry. So 99 has an income of 58,000, almost 59,000 dollars. 97 has an income of 90 something $1,000. I didn't write it down in the notes, but that's what it is. So together, $156,000 per year, which is about $13,000 per month, which is pretty good. I figure just because of the location, you might. I'm not saying you can, but you might be able to make some money off of parking as well. And you may be able, sorry, and you will be able to make some money off of laundry. There's coin operated laundry in the building. I figure 9 units might spend $50 per month on laundry. So that works out about $450. And I might be being optimistic. Laundry might be more expensive than that. I'm not sure. It sounds reasonable to me to be about $50. Even sounds a little expensive, but I know those machines are not cheap. So we can see from our breakdown here, yeah, we get all that income. If we tally it all up, we're at almost $13,650 per month. So it's a pretty good income. We can see right away we already knew our mortgage payments were $9,500 approximately. So we can see right there we've got about $4,000 after we pay off the mortgage to take care of all the other expenses. And so that's probably not going to quite work out for us. We've done enough of these analyses. We see we'll know already we're probably not going to break even. We're going to pay for insurance. This is a totally wild guess on my part. Insurance is not usually particularly expensive. Obviously, the bigger the building is, the more it costs. Multifamilies are looked at a little bit differently than residentials, but probably you'd be looking at around $2,700 to $3,500 to insure this property. There's a big caveat though. If this property, because part of it is about 100 years old, if this property has knob and tube, if this property has cast iron, if this property has like lead paint, well, it probably won't have lead paint, although I guess it could, but lead paint or the other one, oh my gosh, what's the other one? I forget what the other one is, but there's another hazard you don't want to have in your property. Any of those might bump up your insurance costs quite substantially. I mean, you could easily double or triple this price if you had, say, knob and tube and cast iron plumbing in there. Um, but again, I'm assuming they probably don't. That's something you definitely have to find out in your inspection because you'd have to reevaluate your insurance costs if that were present. Uh, we don't pay for electricity. Things are separately metered here. It isn't clear, but it made it sound like tenants pay for utilities. So they may be separately metered for water. They might not be. I analyzed it as if they were. And then gas. It says there's forced air. It does not say that they're individuals. So I'm pretty sure the building pays for heating and cooling like the landlord does. So I put in about $900 a month. Keeping in mind, um, that system, I'm pretty sure, has forced their air conditioning as well. And now that, of course, is not costing gas; that's costing you electricity. But that may also be something you need to pay for, because obviously, if the whole building is air conditioned, that's coming out of your bill, right? Not the tenant. Um, I've also put in property management, and I put that at 10%. So that's a little higher than what we usually analyze at, and that's just because in Toronto things tend to cost a little bit more. Now you of course don't need a property manager in Toronto because you can manage it yourself. Uh, you should still always do the analysis with the property management costs in place. There's a couple of reasons for this, right? Obviously, the first one is that you know what it costs to manage property if you ever change your mind about managing it. A great example might be you might build up this portfolio, and let's just say you get your portfolio to $15,000 a month in income, right? So you're earning $180,000 a year from your portfolio. That is before you go to work, before you do anything else. That's your income. Well, you might decide at that point, hey, I make $180,000 a year. I want to live in Florida. I want to live in Acapulco. I want to live in Japan, wherever the hell it is you want to go. And so you might decide you're moving, right? And of course, you can't move from this property if it's not managed. So knowing what it costs you to manage it means that you have an accurate picture of how this asset performs when you're away from it, even if you might be able to be around it and actively improve its performance, right? So that's a very, very important thing to know, right? Because a lot of people will buy investment properties that are not investments because they don't work if you don't work them, right? And that's one thing that you have to draw an important distinction between, right? There are businesses. What makes a business a business? Well, one of the primary things that makes a business is that people have to work it in order for it to produce money, right? Now, assets are a little bit different from businesses. Businesses can be assets, but they don't need to be assets, right? And the reason being is that an asset generally produces its income whether you work it or not, right? That is, if you buy a dividend paying stock, I do not require you to do any work next year to receive the dividend, right? That's an investment, right? Same thing. If you buy a property, I mean, no work is a bit of a misnomer, but let's just say if you buy a property and you have a property manager in it and the tenants are pretty good and everything, the property basically will run itself, right? And whatever income it produces will be yours. Now, of course, in reality, you do get phone calls and things happen, but for all intents and purposes, right? It's more or less hands free. It's certainly the type of thing where you may receive phone calls, but the solutions to those phone calls are usually just dollars and cents, and you could take care of those calls whether you're in Acapulco or whether you're in Toronto, right? So that's something that's very important. Even if you have every intention of managing the property yourself, you should still factor in the cost of a property manager because life circumstances can change, right? I mean, I mentioned that you might go to Acapulco because that's where you want to live, but I don't know, you have a family member get sick and you have to move somewhere to take care of them. Life is not always easy to predict, right? So you just want to make sure that you understand how this thing is going to perform in your absence, right? So that you can have confidence about what it is as an asset. Finally, I've got landscaping in my expenses here. um, You'll notice this is a much higher cost than what I usually use in Sudbury. These services are more expensive in Toronto, right? So actually, if you look at the picture of the property, for those of you who can see it, there's not a lot of green space, so you probably don't have to pay for much landscaping in the summertime. Perhaps none at all. There's really nothing here that looks like grass. Maybe a little fringe over there. But obviously, in the wintertime, there's parking here somewhere. Maybe do I have pictures of the parking if I go up to the realtor listing? The pictures aren't loading. There's parking there somewhere. Yeah, I don't have pictures of it. But there is parking. There is parking there somewhere that will presumably have to be plowed, right? So that's where that cost is coming from. And then we can see. So our gross expenses $24,000 per month. Okay. Um, oh, what the hell? I thought I fixed that. I'm I'm sorry, guys. Hold on 1 second because that sheet is wrong. This sheet is right. Okay. So why did it print? That's weird. Okay, doesn't matter. Um, there's an error on that sheet which was making all the math wrong. The taxes, I made a typo when I was typing them in, and I put them as $145,000 per year, and somehow I printed that. I don't know what the taxes are. They don't mention them in the listing. I'm guessing they're about $15,000 per year. They could be a little bit. They could be a little bit lower. Um, I'm thinking about what the tax rates are in Mississauga, which are higher than Toronto's taxes. And I figure a property like this would probably end up paying between $14,000 and $20,000 per year in taxes in Mississauga. Again, property tax rates are lower in Toronto, um, so you might pay a little less. But it is a pretty big property in Toronto where the taxes are not cheap by any means. So I'm guessing you're going to land somewhere between $14,000 and $20,000 a year in property taxes. But that was putting in $14,000 per month, and that obviously messes up your expenses because they're saying I had 20 something thousand dollars in gross expenses, and that doesn't work on property that only produces $13,000. So now that we have the right numbers in front of us, you can see I'm analyzing this out again with our property manager taking $1,300 a month. So keep that in mind. But I'm expensing this out to around $13,300 per month in expenses, right? And again, some months you're not going to have gas because you won't have that in the summertime. So some of these things will spike a little bit. Maybe landscaping too, you might not have to worry about. But in general, that'll be your average monthly cost, right? It's Toronto. So good news is vacancy is very low. In this case, it is. I'm analyzing this at 1.5% vacancy, which is approximately Toronto's rate, and you can see it's quite low. So that's fine, no big deal. Repairs and maintenance, same thing. We're taking about $1,000 a month to put into this property to keep it repaired and maintained and keep everything up and running. So that's fine. That makes sense. Um, I don't know, on a property like this, you're gonna have a big flat roof. If I can go back to the pictures here, you're gonna have a big flat roof, and I can't get the good pictures of the front of it. You're gonna have like a big old flat roof, and that is gonna cost you a lot of money periodically. Also, you probably are gonna have to worry about the windows because it doesn't make any mention of how recently the windows were replaced. So that's something you have to keep in mind as a upcoming expense. So you really want to be pretty disciplined about withholding that repair money because it's probably going to cost you quite a bit. I put in my tenant consideration, which I always do. You can ignore that. It's $180 because we have 9 units, and you have to rent the water tank. It mentions that it's a rental. It might be less than $75, but I'm guessing they've got some pretty big equipment in there. I'm not sure. So I just figured I'd put that in. So every month we're withholding about $1,500. And so if we take our $13,000 of income or so, Elias mentioned that the volume seemed lower before. So it still seems low. You tell me. You keep me posted. I'll do my best to try and adjust things. I'm not sure what I changed, but hopefully you can hear me fine. Uh, Anyways, we get through all of those and we finally get to our final analysis. So you can see here, this property loses between $12,000 and $13,000 per year in cash flow. You could switch that immediately. Like if you purchased this house and you managed it yourself, it would break even in cash flow, right? Because that $1,300 a month would suddenly be yours. That's $15,000, which means if we're negative 13,000, you'd be up 2,000, right? Approximately. So managing this property yourself could make it pretty profitable. Of course, I don't know how easy it would be to manage a property in Toronto. Pardon me. Um, my own personal opinion. This is not backed up by facts. This is just an observation I've made and perhaps a little bit of a bias that I have. But it seems to me like some of the least responsible and most it's somebody else's fault kind of people live in big cities, especially cities like Toronto. And it seems to me like the systems that our government puts in place to help shield those people from responsibility tend to be most in effect in cities like Toronto. And so I personally would worry that you are more likely to find professional tenants in a city like Toronto than maybe you would be in somewhere smaller and further away. I could be completely wrong about that. Um, but that is kind of my attitude when I look at it. So I think that managing a property like this might be a little bit. I mean, it's hard to say if it'd be harder per se because you have a lot more people who maybe would want to rent it, right? There's a lot more potential tenants in Toronto than anywhere else, but you would just have to be careful because I think you're much more likely to run into a professional in Toronto, right? I think I don't know, but I think we've probably all seen the news from the last like year or two of like crazy Toronto tenant thinks they shouldn't have to pay rent because of COVID or something like that, and then they're like protesting and they've joined the NDP and they're gonna fight for their right to not pay rent, I guess, and they're gonna fight for their right to a house or something. I'm not sure. These people they're confused, but regardless, they could end up being your tenants, right? And so that is something I would definitely consider. Certainly, if I was going to manage it myself, because you're going to want to do your best to avoid those people. Bad tenants. Well, real estate is very interesting. This is just an aside, but real estate is very interesting in the sense that we talk about the asset, the property, blah 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 blah, and whatever it is, whether we're talking about the mortgage cost or the taxes or the pity or whatever, all these different terms for the property are very important because the property is the asset. But that's kind of a lie. The asset is the people who live in the property, right? They're the ones who actually go out every day and work to earn money to pay you for the property. And if you put people in there who don't work, obviously they can't pay you for the property. If you put people in there who don't want to pay you, obviously you have a problem, right? So really, while the property is obviously the asset in the truest sense of the word, because the people come and go, um, the people inside of your asset are really the thing that are paying you. They're really the important thing to pay attention to and to take care of, right? In a properly free market, that is where the government wasn't distorting things the way that the government does here in Ontario, you would be highly incentivized as a landlord to give your tenants gifts if they were good tenants and to really try to incentivize them to stay. Because in a free market, essentially asset holders would be in competition for the best tenants of their assets, right? And that's a time honored tradition. In fact, not to derail things here too much. I'm not a religious person, but I am going to bring up a quick story from it's a biblical story. In the Bible, there is Joseph. Joseph Joseph's story. It's a long and very famous story, but a part of Joseph's story, right, was that Joseph, as a young man, went to go work for an older man who I guess was kind of like a lord. He had lots of land and he had flocks of sheep and all these things. And so Joseph didn't have anything, so he went to go work for this guy. And so basically, he became this guy's tenant, right? And the guy said, okay, here's this piece of land that I have, and you can work this land with my goats. And as long as you produce a certain amount and you pay it to me, then you can work the land and you can keep the profit. And so Joseph, he did all this, whatever. And it turns out, for whatever reason, because it's a Bible story, I guess, Joseph is really freaking good at herding goats, right? Much better than everybody else. And so he herds the goats. And even though this land, everybody thought it was crap land, because he's really good at shepherding, he ends up growing his flock and he gets all these goats and he really impresses the landlord. And eventually, I mean, this is really old school stuff, right? So back then, you didn't have like a landlord tenant agreement and there was no landlord tenant board. Instead, you signed a slavery agreement where you basically said, I am yours and I have to work for this period of time. And this is our arrangement. And at the end of that period, I get my freedom back. That's literally the kind of arrangement you had to sign. So he became the dude's slave, whatever. And he's the best damn slave the guy had. So he ended up making him a bunch of money. Of course, the end of their agreement comes along. Of course, the guy lets him go free. But then he's like, hey, like, you're free, but like, I'd really like you to stay because you're making me a lot of money. And then he sweetens the deal. So he goes from like, you have to give me a half of everything you produce. Now you only have to give me like a quarter. And then I'm pretty sure Joseph ends up marrying his daughter. I'm a little rusty on the story. But, anyways, all this is just to say that for thousands of years in a free market, landlords have always been incentivized to take good care of their good tenants. Um, Obviously, in the modern world where the government has involved itself in our lives so deeply, um, it doesn't really make sense. It doesn't really make sense um, to treat your tenants so warmly because they're much more replaceable and they provide you with much less value, right? Because of the landlord tenant board, you can basically never get a tenant like Joseph who's going to be exceptional and pays really well and takes really good care of your property. Someone like that is going to be very, very rare, right? And so he doesn't. No particular tenant brings you particularly hard pardon me. No particular tenant brings you a high marginal utility relative to the other tenants because the way the government has done things with the landlord tenant board and kind of rental rates and the way the market just works right now or doesn't work, um, the standout tenants, so to speak, are not allowed to stand out, right? Um, and so there's not really much that you as a landlord can do, right? But I want to make the point because there are places in the world, obviously, where the markets are a little bit freer and where you are incentivized to take good care of better care of your tenants, right? Toronto not being one of them. And in those situations, you might take care of them by giving them a little bit of a break on rent. You might take care of them by giving them gifts at Christmas and Easter or Canada Day or whatever. I don't know when people give gifts, but buy them a bottle of wine once a year, something like that. Those are all things that you could do, and you still can do. That's one of the reasons I include the goodwill in there. So if I have good tenants, I would like to do that. But those are all things that you can do to kind of help make your tenants feel good. And the better your tenants feel and the longer they stick around, the more money you make, right? Because it costs time and money to replace tenants. Even if you have a really high demand building, all things being equal, assuming your tenants are paying market rent, it is cheaper to keep them than to replace them, right? Also, just think of like the wear and tear of like moving people in and out and everything. Like there's just a lot that goes into the whole turning things over. That if you can maintain a happy, stable, positive relationship, those expenses aren't incurred. Anyways, back to the analysis, the 5-year breakdown here. We'll go real quick and then we'll look at something else. So you can see, obviously, we lose money on cash flow unless we manage it ourselves, right? Uh, Obviously, we're paying off the mortgage, right? Those $9,000 a month mortgage payments, they add up. Turns out we're paying off almost $51,000 per year in mortgage payments. Okay, so that's the tenants who are doing that, right? So that's pretty good. At 2% appreciation, which I think you will all agree is pretty modest for Toronto, this property should improve in value about $60,000 every single year. So together, the principal recapture and the passive appreciation, you'll notice that this property should, in theory, be making over $110,000 per year so far. Now we did lose 13,000 to cash flow. Although if you manage it yourself, you didn't do that. But still, you can see that we're somewhere around $100,000 of profit so far in year one. Now my active appreciation kills that entirely. Basically, I think this property is overvalued. So I said that its market value is equal to its sale value. I actually don't think that's true. Like I said at the start, it's probably only worth 2.7 mil. So here, this active appreciation figure doesn't actually represent active appreciation. It represents all the expenses that we had to incur for closing, like land transfer tax, that we paid out above that $3 million price. And so that's all money that we lost, right? So this year we lost $60,000. So it basically wipes out our passive appreciation the first year. Uh, yeah, that's how that works. Obviously, you don't need to pay $3 million. Obviously, these numbers look a lot different if you pay, for example, 2.7 mil, right? And we can actually look at that in a second. Year two, you see, we're going to lose the cash flow every year as long as we have a property manager in there. That's not really realistic because if you turn over those units a couple times, you may be able to get the rents high enough to cover um, that extra $1,000 a month or so that you're paying for the property manager. Right? I mean, you have 9 units, so if you could spread out a $120 per month increase to all 9 of them, you'd have that paid for, right? And that's probably pretty realistic in the course of 2 or 3 years. Of course, we captured for the mortgage 52,000 this time, and for the principal, and for the appreciation around $61,000 this time. We don't lose money this time because of active appreciation. So in your second year, your return on investment is $100,000 approximately. And again, that's assuming we're losing money on cash flow. I'm just going to show you really quickly here if we change our purchase. So if we say the after rental value is 2.7 mil, I hope I did that right. Yes. And if we say the purchase price is 2.7 mil, I hope I did that. No, that's not the one just like that. I hope I did that right. Yes, I did. So if we assume both of those things and we come back over, come back over here to the output, right? We can see now that are you still doing? No, no, you're still doing the same amount. Wait, what? Cost of property, value of property. Oh, did I not change that? Market value. Oh, I see. There we go. Sorry, I did not adjust the purchase price, only the market value. So there we go. So now I back my output. We will see this is quite a bit cheaper to acquire now, right? So everything else stayed the same, but our monthly mortgage payment went from about 90, what was it, 9,600 down to 8,500. So we reduced it by almost $1,000, and that's going to help a lot on the cash flow side of things. Also, we now only require $730,000 to. That's a neat feature. Uh, we we now require a lot less money to close. Yeah, you raised the hand. I don't know how
Okay, and maybe I missed this part, but is that the stated rent?
Mhm.
Sorry, the analysis is based on the stated rent from the listing.
That's correct.
Okay, did do you think that it is market value that rent or no?
Um, honestly, I'm not sure I have enough information to say. The reason why is because I know the triplex is two beds and a one, but I don't remember. Maybe if I check the listing, I kind of read through it quickly. I don't remember if the sixplex. Yeah, see, the sixplex is five one beds and one two bed. So I'm thinking that the rents. Oh, sorry. I'm thinking the rents seem a little low,
Mm-hmm.
probably for two beds. But for one beds in Toronto, I'm not sure what the rate should be. Um, Probably like if you assume an average of about $2,000 per unit, which is
Mm-hmm.
again a little high for a one bed, but if you just assume that 2,000 times nine, we should be somewhere near $18,000 per month, right? And obviously we're only at 13,000. So like
Mm-hmm.
I think there's probably some wiggle room. Maybe not that full 5 grand, but maybe two or three.
Okay.
Right? It's
Yeah, I was
definitely.
just wondering because I was thinking about it.
Sorry, Almond, you got real quiet there. You were good, and then you got real quiet. I'm sorry, Armando. I don't know about everyone else, but I can't hear you right now.
Hold on, Eric, can you hear me?
I can hear you now. Yeah, no problem.
Yeah, sorry, I think I was getting a call. No, I was
Oh,
saying, yeah, I was the reason I'm asking because I was wondering if maybe you could turn over some of the units and get the rent up right away. But yeah, I think that's worth looking into maybe to see how uh how much like one bedroom rents are in that area.
yeah,
Mm-hmm.
yeah. My guess is they're probably a little bit low, and realistically, at least turning those rents over short term is not going to be easy. Because probably those tenants are in there, they're probably comfortable. You know how it is in
For sure.
Toronto, right?
Yeah.
You're gonna have a hard time getting people to leave in Toronto because they know they will not be able to get the rent again. Like
No,
nobody's
definitely.
under the illusion that they can leave a one bed and move into a new one and pay the same amount in Toronto, right? So
No.
so most people are going to be very sticky. There you go. Sean pulled it up. One beds are around 1,400 bucks.
1431.
Yeah. So I'm guessing that because he's got six one beds there times $1,400, right? That's $8,400 in rent there. Then I throw on my three beds times three. Let's call that 6 grand. Like we're close to market rent at that 13th thou. We really are, assuming that 1430 is the number in that particular neighborhood versus the Toronto average. It could be, uh, that rents are a bit higher in this particular locale. Um, but yeah, I would, if you were going to purchase this property, you could definitely purchase it with an eye to the future for what your rental rates are going to be like. But I would not expect you to be able to turn them around in the first 6 to 12 months. Right, that might be more of a 2 to 3 year long project that you'd be embarking on. Right. Um, oh, that was funny. Anyways, we brought down the mortgage payment. Right. That is going to affect obviously the payment for principal and interest. It also technically is going to affect some of our other math. But you can see here, I'm going to skip all that stuff because I don't want to, I'm running out of time. You can see here from cash flow, right? Just by, I mean, obviously $300,000 is not an insignificant amount of money, right? But by reducing the purchase price from 3 mil to 2.7, we've now almost eliminated our negative cash flow, right? So that $12,000 we were losing is now down to only $1,600. That's much, much, much more manageable. Now, our principal recapture has also come down, right? Of course, one of the interesting things is the bigger the value of the property that you are buying, the bigger the mortgage payments are. And since half of the mortgage payments are to you, not to the bank, well, they're to equity, right? Uh, our income from principal recapture has fallen, right, by um, what is that, close to $8,000, I guess, somewhere around there. Um, our passive appreciation also slightly falls. Obviously, if we don't value the place at $3 million, then our 2% is coming off the lower valuation now. So that's also gone down by $6,000, right? So you see, by paying a lower price, in fiction we're making less money. That is because these are all speculative numbers, right? In reality, it's easy to say, oh, if I paid 3 million and say, okay, I'm gonna get 2% on that. But so that's a quirk of kind of how the analysis and the math works. You've always got to remember that yes, I could always increase the price to increase the principal recapture, but obviously that doesn't actually work in the real world. Although it is a strategy that some investors look at. Principal recapture is a great way to make money because principal recapture is tax free, right? Well, it's okay. No, hold on. I'm kind of lying about that. Principal recapture is tax free as long as you don't sell the property, right? So when you have a property and someone pays down your mortgage by $50,000, right? It is as if someone paid off a line of credit $50,000. And usually, for most lenders, you can go back to them and say, "Hey, I want to borrow that $50,000 again." And when you do that, they don't charge you taxes. The government doesn't charge you taxes. Nobody charges you taxes on that $50,000 you've borrowed. And so it's essentially tax free. Every year, you go to the bank and say, "Hey, I want to borrow my, in this case, $46,000 that I recaptured from my mortgage and bring my mortgage back up to 80/20." And a lot of lenders will allow you to do that. Now, you're going to pay some fees for refinancing and canceling the old financing agreement and blah, blah, blah. But in theory, you can do that. And there are some investors um, who that is their model, right? Is they try to buy properties that have a lot of principal recapture. And you can obviously imagine, just to paint the picture, if I had 5 properties that all pay down their mortgage $50,000 per year, um, or sorry. I'm screwing up my analogy here. Sorry. If I had 5 properties that all paid off their mortgage by $20,000 a year, I have 5 of them. They all pay $20,000 a year. Then that would mean that every 5 years they would have $100,000 of equity in them. What some people do is they call this laddering, and you can ladder. There are different ways to ladder, different investment structures. Principle can be applied to multiple different things, but some people will ladder their investments so that they can pull out the principal recapture on a schedule. So in my scenario where you're getting $20,000 per year in principal recapture, what some people will do is they'll buy a house every year for 5 years. And then at the end of the 5th year, the first house will now have accrued $100,000 in value, which they can then pull out tax free. And then from that point on, every year after that, one of their houses will have had 5 years to accumulate $100,000 in equity, which they can then pull out. And so after 5 years of acquiring properties like that, they are then in a position to pull out $100,000 in equity every year in perpetuity. And so that's how some people ladder their investments so that they can pull out a fixed income uh, every annually, right? And so they're not relying on rental income in this case. They're not relying on cash flow, right? And they're not relying on appreciation. They're just relying on the fact that their mortgages are sufficiently large enough that they're paying about 40 grand a year or so in mortgage payments, which translates into about $20,000 a year in principal recapture. And over the course of 5 years, that builds up to $100,000, right? That is a completely valid strategy that some people use. It is tax free, right? It has a lot of advantages, right? And obviously, it is easier to find deals like that than it is to find deals that cash flow, right? People want cash flow. People highly value cash flow. I highly value cash flow. Um, Principal recapture is not quite as highly sought after, right? So you can find properties that are maybe cash flow neutral, right? If you can find 5 properties that are cash flow neutral and you can ladder your investments like that, you can put yourself in a position where you're not relying on the actual cash flow. Pardon me. You're relying on the cash flow of the property to keep things neutral so that you're not pumping money into it. But you're not relying on that cash flow to actually pay you the return. For that, you're just waiting for the mortgage payment to have built up enough equity, and then you're pulling that out, right? Um, there are, of course, should go without saying, but there are, of course, risks associated with that type of strategy. One of the primary concerns being that if something were to happen to the market where you were to suddenly lose a bunch of equity, you may not be able to pull out your laddered payment on schedule, right? If for just to give you an example, let's say you're 3 years in on the property, so you've got $60,000 accrued, and you need 2 more years to go to get across the line your 100,000 and pull your money out. If the market retreats 33%, right, then now you don't have $60,000 of equity in your property. You only have 40, and over the next 2 years, you're only going to acquire $14,000 per year instead of 20. So you're only going to end up at around $68,000 or so after 5 years instead of at 100. So that's the risk that strategy incurs. Obviously, there are other risks, right? Your tenants could not pay your mortgage. You are more susceptible to vacancy when you do that because you have less margin of error since you don't have cash flow to cover and to necessarily build up reserves. Then vacancies hurt you more because whenever the building's vacant, that means you're paying the mortgage instead of the tenants. And so you want to work really hard to keep things tenanted if you're going to follow that type of a strategy. But that is something that people do. Sorry, that was a major aside, but you can see here, just going back to our principal recapture. Now the property is only going to sorry, I already did principal recapture. Going to passive appreciation. Now the property is only going to appreciate by $54,000 per year. Again, in reality, the appreciation has not changed at all. We're just playing with the numbers, right? If the property is valued at this price, this is what the appreciation would be. If it's valued at another price, that's what the appreciation would be. The value of the property is not what we pay for it. It is what the person after us is willing to pay for it. And if you overpay for something crazily, if I pay $6 million for this property, for example, I am not going to receive $108,000 per year in passive appreciation, right? Because nobody else is willing to pay me above and beyond my $6 million I overpaid, right? So that's something very important to keep in mind whenever you're running this analysis or you're thinking about these numbers. Is don't confuse the action that you're going to choose to take for the action that the marketplace is going to take, right? Because they are separate things, and sometimes if you're a fool, the marketplace will look at you and say that you're a fool, and it won't play along with you. Right? That's very important to keep in mind. Obviously, in the case of this new scenario where we pay $2.7 million for this property instead of the $3 million, okay, we can see our first year is still not very impressive. It is a little bit better than before because we lost less money to cash flow, but it's not really all that impressive. One thing to keep in mind here is we could bump this cash flow by $13,000. All you need to do is manage it yourself, right? That's still an option. So you can see at 2.7 million, this starts to become actually a decently attractive property. You could potentially live in it for free and manage it. Potentially, it's gonna depend. You might not get quite that much income out of it, but into our second year, you see our principal recapture goes up a little bit, as does our passive appreciation. It's going to do that every single year. But you can see now on this year, without the losses from the purchasing and all the closing costs, right? So here it's just straight ownership. You see, our total return on investment, $100,000, right? For that 1 year. Year 3, 102, year 4, 105, year 5, 107. In theory, if you bought this property and you could hold it for, let's say, 10 or 20 years, right? You're looking at an average yearly return of somewhere around 17%, 16.5%. I've explained this before, but this sheet of mine cannot be trusted for long term projections because it makes too many assumptions about the future. Um, one of the things it assumes is that your cash flow never changes, right? It does not account for the fact that you can raise rents. It does not account for the fact that you can turn over tenants. Obviously, 5 years from now, your cash flow is not going to be negative $1,600. Like all things being equal, a couple of your tenants are going to move out and you're going to get some market rents and your cash flow is going to go up, right? So that's something that just my sheet assumes that you're going to make less money than you're going to. I try to make all, when you're doing these analyses, you make assumptions. It's just the nature of the game. Uh, but I try my best to set up at least my spreadsheets and my analyses so that my assumptions are always in a conservative direction. Because you always want to underestimate your income and overestimate your expenses, then underestimate your expenses and overestimate your income, right? So that's a very important thing. I would think that in a property like this, by year 5, you could probably easily, like assuming you even had a property manager who was charging you 10%, which both the 10% and having a manager at all are both expenses you probably don't need to incur. You probably get one a little cheaper. But let's just assume 10% and all of that. You could probably still have this thing cash flowing by year 5. I would think you could probably even have the cash flow up in the maybe a few $1,000s by then, just because again rents are going to go up and they're going to go up and they're going to go up, right? And very unlikely anything's going to stop that. Also, my sheet makes some assumptions that you can't about the principal recapture beyond year 5. I don't know what your mortgage is going to be, right? In Canada, you're not allowed to have a mortgage for longer than 5 years because we're children. So who knows? Who knows? You could pay more, you could pay less. It's very hard to say, right? It's hard to make a long term projection. For those of you who aren't aware, in the States, you can get a 30-year mortgage where you sign the papers one time and you don't ever have to think about it again for 30 years, which, like, what a beautiful, magnificent thing. Why can't you do that here in Canada? I don't know. I don't know, but you can. So you can also get a 15-year mortgage in the States, which is kind of in the opposite direction, which you also can't get here. Also, I don't know why. So some of these assumptions about the future, when you look at the 30-year projection, and it's sitting there saying it's going to be worth like $5 million and you'll have made 500 something percent. That's wrong. It'll probably be worth a little bit more. It will probably have produced a lot more cash flow by then, and so those are things that one has to take into consideration. Also, here you can see my principal recapture. It goes up every year, which is true. That is what principal recapture does. Um, but this is misleading. Let's say you were going to follow my laddering strategy. Well, then year 1 you'd get 46,000. Year 2 you'd get 47,000. Year 3 you'd get 48,000. Year 4 you'd get 49,000. Year 5 you'd get 50,000. After 5 years, you'd get $241,919.18. It's pretty good. That's just the principal recapture. That's pretty good. The thing is that if you follow my 5-year strategy, then in order to access that $241,000, you have to now refinance, right? Or you have a HELOC. But one way or the other, you've got to pull that money out of the property. Okay. Let's just say you do a refinance to keep things simple. When I do that refinance and I pull out my $241,919, then I do not continue to do principal recaptures down to year 10. Instead, I have to restart back from year 1 because I've gone back to my 80-20 ratio, which means my payments are now paying the same ratio of debt to equity as they were in year 1, right? Here you can see on my sheet in year 25, I've got $83,000 in principal recapture. That is how principal recapture works, right? I've shown you guys the graph before where you've got the two lines, and one starts low and goes high, and the other one starts high and goes low, and that is uh, um, what is it? Equity and principal, right? So principal starts high and goes low until you pay it off, and equity starts low and goes high until you've paid it off and you own it all, right? That's how it works. Every time you refinance, you're resetting those two back to their starting points. So while at the end of the graph, your arrow is very high for equity, and therefore almost all of your mortgage payments going towards equity, which is why $83,000 is my principal recapture in year 25, right? Well, that only works because I've paid down the mortgage. When I refinance back to 80/20, I have not paid down the mortgage. So I'm back where I started. That's a very important distinction to keep in mind, right? If you um, refinance that money out, right, then you've reduced the amount of future principal recapture that you can receive because you're back to your ratio for principal to equity at the start of the mortgage term. um, Depending on what you want to do with the money, there is a very heavy debate in the real estate investing community about how you should approach this. There are some people. There are some people who believe it is better to have paid off your assets and to own them because ownership means control and blah blah blah, and that's their belief, right? If you believe that, by all means, it's probably a good strategy. I don't think you go wrong with either strategy, but there's just a bit of an argument between the two camps, right? So they believe it's better to pay things off, and so they would rather see that principal recapture remain in the property to get rid of the mortgage, get rid of the debt, get rid of the potential that one day your property could be foreclosed upon and taken away from you, etc., etc. The other camp believes that you should be less focused on control and ownership and more focused on returns, right? And putting your money to work and making it work as hard as it can, as fast as it can. And those people would argue it makes less sense to pay off this property because the more you pay it off, the lower the return you're getting, right? Because obviously you have leverage, right? It's 5-to-1 leverage in this property, right? I put 20% down, the bank covered the other 80%. So 80% of this money is not mine. And as I pay more and more of it off, more and more of it is my money. And so my return is dropping, right? Um, so their argument is no, no, no. I should try to maximize my leverage, right? Pull out as much money as I can, and then find the highest performing investment vehicles to put that money in. So that overall, my money is working very hard, even if I am always at risk of having my properties foreclosed from me if I don't manage my cash flow well, right? Those are the two camps. I can't tell you who's right. I personally would tend more towards the people who want to look for absolute returns than the people who want to own things. I definitely grew up with the mindset and the mentality of you should own things and try to avoid debts and creditors and that sort of thing. But the more I've learned about real estate investing, the more I've kind of seen how financialization can work and the way some of these assets can perform. I don't. I'm not sure that I really see an advantage to ownership, especially when I look around at like kind of what I, in my own personal pers- perspective, uh, what I've been looking around at in Canada for the last little bit. When COVID was going on and they wanted to have a moratorium on rents and they wanted to do these different things, and it was pretty clear to me that, well, what good is owning, quote unquote, owning and controlling your asset if actually the government controls it and they're just going to come in and tell you to do whatever they want, right? To me, it does seem a little bit like the people making the case for ownership are overstating how valuable that is. Whereas if I've taken that money out, and yes, I'm at risk of you foreclosing or whatever, the government stupidity costing me money. But if I've taken all that money out and I'm getting a return somewhere else, I don't know. Let's just say you can imagine maybe I've been taking this $40,000 out every year and buying cryptocurrency with it or something. Like who knows, right? I could be doing anything with it: stocks, cryptos, more houses, whatever. Uh, it is conceivable that I'd be making more money by doing that. And by having more money, I might actually end up with more control, right? When I say control, I only mean about myself, my own life, right? You have financial control over your life. Where do you choose to live? What do you choose to eat? Whom do you choose to associate with? These are the things you have control over, right? You can have $1 billion, you won't be able to control other people, just influence them, maybe even some of them very heavily, but the control is about your own life. I think if you own a bunch of properties that you have completely paid off, then in theory, yeah, all the rental income you get from them is yours, yes. And in theory, nobody's going to take those properties from you, yes. But I'm not so sure that in reality that is how uh, things quite work out. Because I just, for me personally, it looks like you don't have nearly as much control as an owner as you would like to. And if you're not getting the perks of ownership, then it's basically just an investment vehicle. That sentimentality of owning it and controlling it is kind of not there. I think you could probably find better returns. Right? If you leave all the money in this thing and you let it become worth $2.7 million, I'm just going to do the math for you really quickly. So 100 and let's just call it $160,000 in rent, okay, divided by $2.7 million, right, is a return of about 5 to 6%. So you can see on the screen, for those of you who are looking, I've got a 5 year average return of 12.5%, right? That is in our first 5 years, 12.5% per year. We only own 20% of the property. When we own 100% of the property, it's down to a 6% return. So I just trying to highlight for you how equity affects your return, right? And obviously, if you have $100,000 and you get a 6% return on it, you made $6,000. If you have that same $100,000 and you have 12% return on it, you made $12,000, right? So you see that your income is quite a bit higher, right, by utilizing that leverage. And so that is the debate. I do believe most people are on the side of financializing things, pulling that money out and putting it to work. I think that the people who want to own and control, they're more of a vocal minority. And now you're aware of the debate and you're going to have to think about it for yourself and how what strategy you want to use in your own life. I actually think for a lot of people, when you're starting out real estate investing, perhaps you don't own any properties or you only own one or two. um, for you, I think that there's not really a debate to be had. You should be trying to financialize and trying to acquire a little bit more, right? Because two properties is good. It's better than average. To be honest with you, if you just buy two properties and you go on living your life, you're already financially ahead of 99% of the people you're going to encounter. Maybe not 99, 96% of the people you're going to encounter, right? Um, but if you really want to do this thing well, do it properly, you're going to want to maybe acquire 5, 6, 8, 10, 12, 20 properties, something like that, right? A larger number. I do think when you get to those larger numbers, and I don't know what it is, it's probably an income figure more than an actual like unit amount. You might decide, hey, now I have enough investments. They're throwing off, I don't know, let's say $180,000 a year to go back to my old example. And you know what? I can sacrifice $80,000 of that towards paying down some of these properties so that I have some security. I'll almost consider it like a savings. Um, I can do that at that point. I can afford to do that. And you may choose to do that to kind of more secure, shore up your position financially, right? I think a lot of investors do eventually get to a place where they've acquired enough assets that the return is no longer so important to them. They can't do that much with it, right? You know, your life gets to a certain point. I don't know if you buy a Ferrari, you know, how many more Ferraris do you need? Or, you know, do you need two Ferraris, five Ferraris, 10 Ferraris? Like at some point, you've got too many Ferraris, right? And that's an obscene example. I know Ferraris are absurdly expensive, but I'm just saying, right? Like, there's only so much material in your life that you're really going to want to consume on a year-to-year basis, and once you've kind of satisfied that, then that's when you might consider kind of shoring up your position financially and allowing these assets to acquire some equity. I don't know how it happened, but it is 11:10, which means my seminar is over. I had meant to go to this Google Chrome page, and you can see here I had a couple properties I was going to take you through. Obviously, we had this one here. We also had some stuff in Etobicoke, something in Guelph, and I had actually. I must have closed it, but I also analyzed the property out in the Rexdale area there. I was gonna kind of take you through some of them. They can wait for next week. It's not a big deal. But I kind of got sidetracked here talking about kind of the intricacies of a deal like this and some of the things you need to look out for. Please let me know if you have any questions, and maybe we can address them right now. And if not, I hope you have a great day. I hope you got something out of this. I would really like it if for the next couple of weeks I kind of focus on doing an analysis. I'm really hoping that maybe you will have some properties that you want to bring to the table and we can sit down and look at them together. I'd love to be able to take you through the process, not just obviously looking at the output spreadsheet here or whatever. That's one thing and that's easy to do, but you know, I don't know that anybody wants to watch me literally putting raw data into the sheet like this. Probably not, but you know, we might be able to take a look at some of the other things, some of the resources that I use to get information when I don't have it. Obviously, Toronto is not a market I invest in. I'm familiar with it because I live here, But there are things that I don't know where I may visit other sites or resources to get information, right? Market data, rental data, things like that. Today, obviously, Sean was nice enough to provide us with the average rents for one beds in Toronto, right? I might investigate that a little further, maybe go on Kijiji, look for some comps in the area, try to find things that are specific to this property so we can really nail down that valuation. So that's something we can maybe explore in the coming weeks. So thank you so much for your time. As always, I very much appreciate you joining me on Sunday and learning a little bit about real estate investing. I am confident that the knowledge will pay dividends someday soon, sooner or later. And as I mentioned pretty much every week, the knowledge is only half of the equation. You have to really have the mindset and really develop the confidence and the really it's about developing the confidence, I would say, more than anything, to sit down and after you've done the analysis to say, yes, those numbers are right, yes, I can take action on that, yes, I feel comfortable risking my money. Because I can't tell you how many times I have analyzed a situation in life, not a real estate situation per se, but a situation, an investment opportunity of one sort or another. I've been 100% right in my analyses, and I wasn't confident enough in it to actually take action and make the money, right? So that's a thing that happens. That's probably more of a problem than people not analyzing things correctly, right? So it's something that we all really need to focus on and work on. But for the next couple of weeks, anyways, we'll be focusing on the technical stuff and doing the analyses. So please send me if you have anything that you want to have us look at. Shoot me an email, or here in the meet, you can I don't know, chat in the meet, whatever. Like Armando mentioned, he couldn't hear very well at the beginning of the meet. You can also put up properties there. We can look at them. So if you see anything that stands out to you, you want to have an analysis of it, and maybe you don't feel comfortable or you just want to see what I would do with it, feel free to send it to me and we'll take a look at that in the coming weeks. Okay. You guys all have a great morning. Okay. Oh, I should have mentioned it before half my audience left, but what can you do? Uh, I live streamed this on YouTube this week. I don't usually do that. I mean, I did last week, and now I've done it this week. I'm gonna try to make a habit of it. But so far, I have 0 viewers on YouTube. Oh, because I didn't include the link in this week's email. Oh, I sent it out on the Friday, but not today.
Yeah, I was just gonna say,
Yeah.
where's the link?
Yeah, there's no link. Okay, well, I have to be better. I'm gonna have to figure that out and add the link in. Damn it! And I was so proud too. I had it like set up early, and then I forgot the link. Damn. Well, anyways, that's something that I'm also, I don't know, working on. I don't know. So, just the heads up. I'm gonna keep mentioning it until I see something other than a zero there. That's all, because I want to see people watching who I don't know. Like it doesn't count if Armando you go. I appreciate it, of course, but if you and Natalie go on to YouTube and you're watching, that's thank you. But I want to see like 15 people there who I don't know watching.
Yeah, if you give me the link, I'm gonna start sending it to my lazy ass friends that always say they want to join, but they always complain that it's at 10 a.m. on a fucking Sunday. But they want to learn, they just don't want to wake up. So I feel like if I share it to them and then I bug them, then you can get some more views. Because people like YouTube, they like to be able to learn on their own time, and like I get that, I respect that, I understand
100%.
that.
Yeah.
So yeah,
I do
that's
like
good though, man. That's really good, man.
really 10 a.m. is too. I put like rise and shine in the email because but like that's too early, really. I get it, but
On a Sunday, I guess people like to always let loose on Saturday night, whatever.
yeah, I guess that's what it is. Where you're out partying and everything, but
Yeah.
oh,
No rest for the wicked. Come on, guys. Rise and grind.
that's right. That's right.
I feel you,
All right,
There
well,
you go.
that's what it is. That's what it is. Well, anyways, thank you for your time, guys, and I guess I'll see you later.
Alright.
Both of you probably.
Yeah.
Yeah.
See you.
All right. Have a great morning. Bye. Oh, wrong mouse. That's what I'm doing. End the stream. End.